My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I absolutely love this series. If you're new to my channel, my name is Jake. I live down here in Austin, Texas with my wife. We're looking to retire off of our dividend growth portfolio. I talk about dividend investing, and here, if you look at my channel profile, I focus really on three topics. I focus on dividend growth investing. That's really all things dividend related for all you dividend nerds out there like myself. The second series is the Review My Pie, where I review subscriber portfolios. And then lastly here is around financial independence and retiring early. So my wife and I, we follow the FIRE movement. We're looking to retire 100% off of our dividend growth portfolio here in the next couple of years. And when I say retire off of our dividend growth portfolios, I really mean our dividend portfolios. We currently invest into real estate, physical real estate. We own different homes here in the Austin area, and we rent them out as do-it-yourself landlords. And this last week in Austin has been absolutely insane. Like, you know, I talk a lot about on my channel about how I love dividend investing because it's so passive. It truly is passive. You know, you're not gonna have to check in with your dividends to see if their pipes are gonna burst at sub-zero temperatures in a one-off scenario here in Austin, Texas. Yes, that's what happened here this last week, where we got crazy amounts of snow. Like, I know all of you out in the Midwest and the Rocky Mountains are probably playing your little violin for me here in Austin with my 6 inches of snow. But the crazy thing is here in Austin, we just weren't ready for it. Like, the pipes are exposed, they're not insulated. It was just kind of a shit show. And I mean that honestly, not figuratively, I mean honestly, because some of my renters, they sent me this picture that their water was off. And, you know, you need water for not just for drinking and cooking, but other areas of your life. Like the water got so tight here in Austin, pipes were bursting, just massive shortages that they had to cut off water to certain parts of the city. Now, my wife and I, we were really lucky that we had power, but we went about almost 4 days without water. But luckily, you know, we had water reserves. We actually filled up our tubs with water so that we could, you know, we could have water just in case. But I kid you not, there was people out there that were collecting snow, melting it, and then using it for their toilets to flush their toilet. Like, that's legit how crazy it got. And I use the reference there with dividends being passive and they're not going to call you at night or let you know that their power's out. My renters that live just a couple miles north of me were out of power for about 5 days. They had no power. And here's the kicker. They have an electric water heater, and your furnace is electric. So they had zero power. It was 5 degrees Fahrenheit outside, just absolutely insane. And luckily they had water so they could drip their pipes, drip their faucets. But here, this is the crazy thing about this, everybody. We talk about dividends being passive. They are truly passive. This last week, I was so concerned that we were going to have busted pipes. I called my insurance to lower my deductible. So, because I mean, who thought that there was going to be a crazy snowstorm? Like, it doesn't happen. I mean, that's why you have insurance, yada, yada, yada. But I actually had to lower my deductible so that just in case I had to use my insurance, I didn't have to pay like 10 grand in a deductible. So that was my experience. If anybody is curious how Jake was doing, you know, how I was doing down here in Austin during this whole snowstorm, this is a good representation of how my week has been going. But long story short, we survived. In today's video, we're going to review 4 subscriber portfolios. The first one is going to be from a 20-year-old here in the United States. The second, an 18-year-old from New Zealand. The third, a 31-year-old from the United States. And the fourth, a 35-year-old from the United States. And as always, everybody, I don't pre-script what I'm going to say. I'm reviewing the portfolios for the very first time. And as always, I'm not a financial advisor, so don't take what I'm saying as financial advice. It's just merely my opinion. I'm just some random dude here in Austin, Texas, dealing with snow issues. You know, I'm just a normal guy, right? So don't take what I'm saying as financial advice. It's just really for your entertainment. I'll leave timestamps in the description below if you're just interested in one of the portfolios or whatever. You can check out the links in the description below. I also link their portfolios in the description below if you want to check them out. And a lot of you have been emailing me asking if we can meet one-on-one. I've been really, really busy these last couple of months with the move, right? If you've been following the channel, my wife and I, we just recently moved to a new home. We rented out our old house, but I set up a site here that you can book directly with me. Like I work full time, right? I have a 40-hour job. I work full time. I do YouTube typically on Sundays, and then I respond to comments throughout the entire week. But I'm typically working like 6 days a week. But I think it would be really cool, and it's been so great meeting and speaking with a few of you here these last couple of weeks. And I updated the site here, so if you do want to book some time with me, I blocked off time Monday through Thursday for 2 hours at night after I'm done working my 9 to 5. If any of you do want to book some time with me, we can go over your portfolio. It's really just a way to interact with you. We can bounce ideas off. We can talk about stocks, but we can do it through Zoom. We can do it audio only. We can do it video. You can see my beautiful face, all that fun stuff. And actually, speaking of beautiful face, I probably should shave and cut my hair because we've been without water for so long. I look a little scruffy. But yeah, it's not financial advice. It's just, to bounce ideas off. I can't tell you what to buy or sell, but if you're interested and you want to, talk stocks and dividend investing, I'd love to meet you. All right, let's take a look at the first portfolio. The first is from Shawn. He writes, "Hello, Jake. My name is Shawn, and I am a 20-year-old college student. I am studying aerospace engineering, and so I don't currently have much to invest aside from summer jobs and DoorDash money. However, about 10 months ago, I began investing to learn as much as possible by the time I have a real income. I'm interested in dividend growth with time horizon of approximately 30 years, at which time I plan to completely replace my income. I just recently liquefied and transferred my account from TD Ameritrade to M1, so I'm still getting used to their platform, but I enjoy it so far. Any feedback you could give me on my allocations would really help me in my learning process." Okay, very cool. So you're 20 years old. You're going to college. You got some side jobs. You're door dashing. This is great. I think this is awesome. And you transferred from TD Ameritrade. That's interesting. I used to use TD Ameritrade as well. TD Ameritrade acquired Scottrade, and so I'm very familiar with TD Ameritrade. And like you, it was very different when I first started using M1 Finance. I was really skeptical at first. The user interface was different. I was used to being able to trade whenever I wanted. M1 is very different. So there's a little bit of a learning curve. So let's take a look at your portfolio. You're up 81% over the last 5 years, not considering the reinvestment of dividends. Your dividend yield on average is about 2.5%. You have 0 ETFs. You don't have an expense ratio, and you have 24 holdings. All right, the performance is good. The dividend yield is good at, looking at just purely at the numbers. Let's see how you have your portfolio set up. So it's skewed heavier in tech. You have consumers in there. You have healthcare, finance, real estate, telecom, industrials, and energy. Okay, very interesting. You said a 30-year time horizon. So if you're 20 years old, the time horizon really, it doesn't matter how old you are today. It really depends on when you plan on leveraging the dividend. So instead of reinvesting the dividend into your portfolio, when do you plan on using the dividends to pay for your gas, your utility bill, your food, your expenses? That's really the question that you have to ask yourself. And now obviously it's not always easy. Nobody really knows what they're going to be doing 10, 20, 30 years from now, but that's why we have goals, right? We set goals and we understand that it's kind of a moving target, right? And we take the best guess possible with the information that we have. Right? Really, really important. So I like that you have tech at 28%. I like that you have energy at the lowest. Energy, I'm really interested to see what you have in energy in here. But let's take a look at your first slice. Your first slice is just over 200%. This is massive. All right, so you got Apple, you got Visa, Microsoft, Amazon, and Virgin Galactic. I mean, this is really interesting. So Apple, I don't think anybody can go wrong with Apple. With Apple, if you watched my last video, there's fundamental reasons of why I don't overweight my portfolio into Apple. And so if you're interested in that, you can check out that last video. But essentially, Apple is such a growth company, and I don't think anyone, in terms of total return, capital appreciation plus the dividend, I don't think anybody can go wrong investing into Apple. But I think, it's important to understand what is your goal. If you plan on never selling your shares, it's going to take you 30 years to really leverage the power of compounding from the dividend, just looking at the dividend from Apple, Visa, and Microsoft. So 30 years, I think if you're saying, hey, in 30 years, I want to, live off of my portfolio, these holdings are going to be great. Your portfolio value is going to be in the millions, like incredibly, like in the millions, literally, depending on how much you're funding the portfolio. But if you're funding it a couple $100, maybe a week or a month, you're going to be amazed by how fast the portfolio is going to grow. But in terms of the dividend, it's going to take 30 years to really reap the benefit of the dividend with Apple, Visa, and Microsoft. Amazon is great. I think with Amazon, I wouldn't hold it against Amazon in the next 5 years if they don't start paying a dividend themselves. I think I could definitely see Amazon paying a dividend. I can't really see like Netflix or Facebook paying a dividend or Google, but Amazon, I could see Amazon paying a dividend in the future. Maybe not in the short term, but in the long term, I could definitely see it. All right, let's take a look at your next slice here. In consumers, you got your classics, you got your Pepsis, your Coca-Colas, McDonald's, Disney, and Home Depot. I love every single one of these companies. When it comes to your time horizon of 30 years, I think you could lower Coca-Cola and you could probably bump up Home Depot. I think, in my personal opinion, I would swap 25 and 15. I would put Home Depot at 25 and Coca-Cola at 15. That's just my opinion, simply because of the growth rates, how quickly Home Depot is growing compared to how quickly Coca-Cola is growing, and your time horizon. So, you could even, like with 30 years, honestly, 30 years, you could bump up Disney and McDonald's, and you could even lower Pepsi a little bit. These 5 companies are amazing companies. They have their own economic moat in a way. I think, I would go so far as to say that in 100 years, these companies are going to be around. These are going to be around for your great grandkids, right? Pepsi, Coca-Cola, McDonald's, Home Depot, Disney, they're not going anywhere. These are great companies. Let's look at your healthcare. With healthcare, you got Johnson & Johnson and you got Pfizer. I love that you have Johnson & Johnson at 85 and Pfizer only at 15%. With a 30-year time horizon, I like 2 others that I am personally invested. I like Medtronic, ticker symbol MDT, and I really like Stryker. These are really, really good healthcare companies, and they have lower starting yields. They make a small percentage of my portfolio, given my time horizon, but with a 30-year time horizon, I definitely recommend checking those out and see if they would make a good fit into your portfolio. The Strykers and the Medtronics of the healthcare sector are kind of like your Apples or Microsofts of healthcare. They're massive growth companies. Let's take a look at your finance. Your finance slice, you got Bank of America and you got JP Morgan. These are both, established banks. I would encourage you with a 30-year time horizon. There's a couple that I really, really like. I really like Standard & Poor's, ticker symbol SPGI. That is like your Microsoft and your Amazon. If you have a 30-year time horizon, I would highly recommend checking out SPGI. Really, really strong. I also like Aflac, ticker symbol AFL. I don't invest into either of them into my portfolio simply because of my time horizon, but with 30 years, highly, highly recommend it. I think long-term over the next 30 years, I think those would make a great addition to your portfolio. All right, let's take a look and see what you got in real estate. So in real estate, you only have 9%. I like that you only have 9% because real estate is taxed differently. Real estate is taxed at your ordinary income rate. So if you're making more, if you're higher than a 15% tax rate, which most people are, you're going to be paying more in taxes to hold these dividends in this slice. And so what do you got in here? You got realty income, you got American Tower, and you got DLR. DLR, I like all of these. In my opinion, for 30 years, I would reduce realty income and I would increase American Tower and DLR. I like both of these. I also like Crown Castle, ticker symbol CCI. But in terms of your portfolio and your time horizon, you really want to focus on growth. Realty income is not growing nearly as fast as the other two. And that's why I would recommend, in my opinion, lowering Realty Income and increasing American Tower and DLR. You're going to have a lower starting yield, but you're going to notice the performance is going to be dramatically higher, and that's what you want. If you've checked out some of my other videos, I'd recommend checking out other videos that I talk about time horizon, and that'll make a little bit more sense because the math doesn't lie. When it comes to your time horizon, you want to focus on growth. All right, let's take a look at your telecom slice. You got it at 8%, AT&T and Verizon. Yeah, I mean, what do you got here? 8%? It's a little bit high for a 30-year time horizon. You may want to even consider adding Comcast, maybe. Comcast would make a really, really good addition. In my opinion, I think for 30 years, lowering AT&T, lowering Verizon, and adding Comcast would, in my opinion, make a little bit more sense. Or if you don't want to add Comcast because you think for whatever reason, maybe lowering the allocation to telecom a little bit more, I think could make a little bit of sense. I think with telecom at 8%, it may be a little bit high. Industrials, you got 8%, you got 3M, Waste Management, love seeing Waste Management in there, and you got Honeywell. Okay, great. So I like all three of these companies. I think you could also consider looking at other companies that are growing a little bit faster, right? You could look at a Union Pacific, ticker symbol UMP. You could look at Lockheed Martin, for example. It's another really good one. Other companies that are growing their dividend faster. You could look at Caterpillar, for example. Caterpillar is another great growth industrial. With 3M has a great track record. But I think in terms of like growth over the next 30 years, I think I personally would have Honeywell and Waste Management higher than 3M with a 30-year time horizon. And once again, I keep saying this, you're going to have a lower starting yield, but that's okay because in the background, the dividend growth is growing exponentially faster. By the time you're looking to use the dividends in 30 years, you're going to be much further ahead than overweighting your portfolio and this slice in 3M, for example. All right, let's take a look at your last slice here in energy. It looks like you have two. You got ExxonMobil and NextEra Energy. Okay, so NextEra Energy is really classified as a utility, but I think, for this purpose, we'll just compare the two here in the allocation weighting. I personally, with a 30-year time horizon, I like NextEra Energy a little bit more. ExxonMobil is a good income stock for right now, but I just honestly, I'm not very bullish on oil. For the next 30 years, I don't think oil is going to go away anytime soon. I think if you're invested into Exxon or Chevron, I think you can sleep well at night. I think you're fine. But if we look 30 years into the future, I just don't know, right? And I think with NextEra Energy, I personally would feel more comfortable overweighting or having a higher allocation in NextEra Energy than ExxonMobil, for example. So that's my opinion. I think it's also, with a 30-year time horizon, it's a lost opportunity if you're focusing more on a current high yielder like Exxon versus a NextEra Energy. I think another one that I like, if we're looking at utilities, I like Duke. Duke Energy is a good one, ticker symbol DUK. But yeah, that's just my opinion. Well, Shawn, thank you so much for sending over your portfolio. I like that you have a manageable, only 24 holdings in there. It's not crazy. It's manageable. You can follow up on these companies. You have a healthy dividend yield. I think there's a few adjustments that you can make into your portfolio that could optimize your returns over a 30-year time horizon. Once again, I would focus allocating or skewing more towards growth. What you will notice is when you do that and you refresh your pie here in M1 Finance, you're going to notice that the performance is going to go up dramatically. This is historical. It's not guaranteed, but it's historical returns. And your dividend yield, your current yield, is going to go down. But that's the thing with your time horizon of 30 years, you want to focus on the growth. I hope that helps. Thank you so much for sending over your portfolio. All right, let's take a look at the next portfolio here from Jared. Jared writes, "Hi Jake, my name is Jared. I've just turned 18 and I've been investing for about a year and a half now. I am from New Zealand and currently my portfolio is just over 12,000 New Zealand dollars or around 8,700 US. That is so cool, man. My wife and I, we were in New Zealand just before the pandemic here in December of 2019. absolutely amazing. We definitely got to nerd it out. We went to Hobbiton. We went to the North and the South Island. Absolutely love New Zealand. If I could retire tomorrow and I had enough money, I would go and live in a camper van for a year in New Zealand. I loved it. My wife and I, we loved New Zealand. All right, you continue writing here. This year, I will be starting university, studying a Bachelor of Commerce with intentions of majoring in both accounting and finance. I plan to invest my student loans, about $240 PW, I'm not sure what PW means, as it has 0% interest rates unless you travel overseas for more than 6 months, which I do not intend to. I have a time horizon of 25 to 30 years with the intention of growing my portfolio to 20,000 New Zealand dollars by the end of the year. Wow. And 40,000 New Zealand by the time I finished university in 3 years. Currently, my portfolio yields around 3%, but would like to remain around that over the next 3 years. Currently, my portfolio has quite a large weighting in recovery stocks, AR, AIA, and CCL, which I plan to sell or significantly reduce my position in within the next 3 years. I plan on investing more into high growth, dividend growth stocks and ETFs in the next few years, as my portfolio, I feel, is a bit too conservative for my time horizon. Over the next few years, I intend on having around 30 to 40% in growth, high growth industries, and the rest in solid, stable, dividend paying companies. I plan on having around 40% in ETFs and 60% in stocks, with around 25 to 30% in the New Zealand market and the rest in the US market. Holy cow. Now, I want to reiterate that the dude here is 18 years old and he started investing. He's been investing for a year and a half. Now, I'm in my mid 30s and this puts me to shame. Holy cow. The dude here has been investing since he was, 16 and a half. When I was 16 and a half, I just got my driver's license and I was, playing StarCraft or something. Holy cow. Or yeah, I think at the time 16 StarCraft. I think that was the thing then. Goodness gracious. Okay, so Jared, this is amazing, man. I think it's so interesting. You say that you're looking to go and get a degree in accounting and finance, shows that you think about numbers and money and finance. So it's probably interesting for you. You also probably, what it sounds like, you probably have some really good influencers in your life. Maybe your friends, your family, relatives are probably also interested in finance, and that probably trickled over into your interests. So I think this is great. I absolutely love that you have detailed goals. We're talking about 30, 40%. You're using all these percentages at 18 years old, man. You're off to such an amazing start. I think this is so great. When it comes to your comment around investing in recovery stocks, I think investing into growth and then, at first and then transitioning over to dividends or dividend growth stocks, I think that approach can work very, very well. I'm just personally in a different circumstance where my wife and I want to retire in the next, 7-8 years or so. If we had 30 years to go, we would invest dramatically different. In our Roth IRA, for example, we invest pretty much purely into growth because we have over 20 years, right, to grow it. So this is so great. All right, so let's take a look at your screenshot here. I think you sent the screenshot. It's a little bit blurry. I'm going to try to zoom in and see if I can see everything well. It's still a little bit blurry. I'm going to do the very best that I can and see what you got here. So you said that you have some recovery stocks in here. You also got your Altria group. You got your Apple. You got your AT&T. You got your Costco, your Coca-Cola. You got your JP Morgan. This is okay. You got your Lockheed Martin, Kimberly-Clark. Shouting out a few of them that I recognize right off the bat. You got Store. This is a good REIT. Retail REIT, you got VIG, this is dividend appreciation, you got the S&P 500, and you got Waste Management down there on the bottom. Beautiful. All right, very cool. So let's see what you got here. Does it show your portfolio weighting? It does. It shows your portfolio weighting. So you got everything in here is right around 1, 2, 3, 4%. You have a few at 8%. Okay. I like that you have ETFs in there. I like that you have a little bit more diversification. I think a few rule of thumbs that I can give you just generally, and this would apply to anyone looking to invest. These are some of the guidelines that I live by, and I'm going to make an entire video on this in the future, but I'll give you just kind of a snapshot of what I think about when constructing my portfolio. When I construct my portfolio, I'm looking to have no more than 5% in a single company. So I don't want to have 5% in one single company for my overall portfolio. I also don't want to have more than 20% in one single sector. Okay, so those are some of the guidelines that I live by, as well as I want to diversify the payout, right? So you can have one company at 5% and another company at 5%, but you're going to get dramatic differences in dividend income. So I try to manage balance out my portfolio in terms of the dividend that I'm getting and the percent overall weighting that it makes in my portfolio. Okay, so those are a few things that I really live by in terms of constructing my portfolio. When you're 18 years old and you're looking at your goal, I think what I like is by having a diversified portfolio in growth and current income, it gives you options, right? You mentioned before you're investing in these recovery stocks with the intention to sell them in 3 years. I think that's a good goal. I think I personally would prefer to do that with ETFs. That's just my risk tolerance. If I'm going to invest into growth, I really like high growth ETFs. I like the Vanguard Technology ETF, ticker VGT. I like ARK Innovation. I like the ARK funds from Cathie Wood. I think they're amazing. I really like growth ETFs versus just individual companies. And that just comes down to my risk tolerance and my personal preference. I feel like I can sleep better at night. Jared, I think this is amazing. I am so impressed by the fact that you're so young and you have such detailed goals. Some words of wisdom that I would share with you is when you're building out your portfolio and setting up your goals and you're still fairly new and early on in your process of building out your portfolio and your goals, I would really recommend trying to keep it as simple as possible. Don't try to over-engineer your portfolio when you're first starting out. I think it gets exciting. I think it's really, like, hey, this is new. I have this goal. I gotta, the more you put into it, the more bells and whistles you have in your portfolio, we think the better performance you'll have. It doesn't always work that way. When you're first starting out, and this goes for anyone watching the video, when you're first building out your portfolio, I really would recommend starting out slow. Don't go to the moon, don't try to go to the moon on your first try. Start out slow, slowly build out your portfolio, because I promise you what you're going to notice is as you're building your portfolio, your priorities and your goals may change. And so that's why I think starting out slow is so important, and it's going to help you to be a disciplined investor for the long term. So Jared, thank you so much for sending over your portfolio, and the best of luck to you. All right, the third portfolio here is from Ankit. Ankit writes, "Hi, Dividend Growth Investing. First off, I want to thank you for creating your videos on YouTube. I am a noob investor that just finished medical training and discovered financial freedom, independence about a year ago, and just started educating myself on personal finance. Your videos have helped me to understand the power of dividend investing." That's awesome, man. I appreciate it. So you continue writing here, "I'm 31 years old and married, wife also in medicine." So you probably are high earners. You probably have debt if you have a medical background here in the United States, but your earning potential is probably a lot higher. All right, so our goal is to reach financial independence, fat fire. For everybody out there that doesn't know what fat fire is, there's the difference between lean and fat fire. Fat fire, you're retiring on a good retirement where you're not having to pinch pennies. Lean fire is pretty much just you're skidding by. You cover your expenses, but nothing more. In about 10 years, if possible, and hopefully produce a total dividend income of about $100,000 a year. Those are big goals, I know, but can't hurt to try. Hey, Ankit, this is the exact same goal that my wife and I have, by the way. This is amazing. It also obviously depends on where you're living, your expenses. So it's all relative. We still have a large amount of medical school, here you go, school loans left to pay, roughly $400,000 to $500,000. Oh my gosh, between both of us. So we are starting a little slow with the investing. We are largely trying to pay off loans as fast as we possibly can. Goal of 3 years, fingers crossed, after which we plan on dumping as much cash as we can into investments. That's what I was thinking. When you said you were in medicine, I immediately thought student loans. Okay, I think this is a great goal. When you say that you're almost $500,000 in debt, I think about Dave Ramsey. Dave Ramsey and his baby steps are unbelievable. They are so great when it comes to getting out of debt. When it comes to his investing strategy, I don't agree with that. But paying off your debt, I think is a great, I think this is amazing. So you got a big couple, 3 years ahead of you. But once you get that debt paid off, you really are going to see your net worth just explode. So this is great. I have a taxable M1 Finance, Robinhood, and Vanguard portfolio. This is exactly like me. Below is my link to my M1 Finance portfolio. In my Vanguard portfolio, I have VIGAX. This is the Vanguard growth ETF, a growth fund, and plan to fund this every week. It has a low dividend of about 0.5%, but it seems to be growing quickly. Eventually, towards the end of the 10 years, I will add BND or an equivalent bond ETF versus mutual fund and collect its dividend as well. I want to try to avoid selling VIGAX unless I absolutely need to. Okay, we really need, there's a few things that I need to address here, but I'll get to that in just a second. I want to finish reading the email. I have SPHD and PEY, which hold most of my money there. What I want out of these ETFs is a monthly paycheck and hopefully get around 50% of the 100K year goal. I like monthly income, which is why I chose these two. But I understand that I pay for it with the expense ratio. That's true, as I remember correctly. Any thoughts on how to mitigate this but have a monthly dividend ETF? I wish VOAM was a monthly dividend payer, but can't have everything, I guess. That's for sure. My goal is to have a stable growing dividend payout year after year with very little chances of dividend cuts. I also get almost weekly dividend payments, which is great. I also want stable growth in the total value of the portfolio. From looking into Seeking Alpha and a few other places, I think I can be getting this, but once again, I am new to this. Would love to hear what your thoughts are on my portfolio, goals, and game plan to achieve it. Any input is greatly appreciated. Well, Ankit, there are so many great things in here in this email, and I think, I could spend an entire hour with you talking about this in detail. You're off to a great start, and I see a lot of similarities in your goals as with my wife and I. My wife and I, we didn't start off with almost $500,000 in student loans, but we're probably not going to be making as much annually as you and your wife in your profession. I think let's take a look at your first goal here. So I think paying off your student loans is probably got to be your number one priority. I think following Dave Ramsey's baby steps, I think is probably one of the best things that you could do. I think while also investing in your portfolio on the side is not a bad idea. I think it's a good idea to get in the habit of still investing in your portfolio while you're aggressively paying down your student loans. When it comes to your first portfolio, I really like the growth ETF here from Vanguard. I like investing into this ETF because it gives you options and flexibility. Let's say, for example, 5 years, 6 years, 10 years, you need to buy a house, or you have a major expense, or you want to transition out of growth into high dividends. You can do that. And I really like the flexibility that provides. When it comes to adding bonds to your portfolio, I personally can't speak for everyone in the FIRE movement, but typically in the FIRE movement, we typically don't hold bonds. It would be more so in the traditional FIRE movement, you're holding the entire stock market, right? VTSAX. I personally, I can't speak for everybody, but in the FIRE movement, I plan on never holding bonds. It's just not and I mean, that could change, but I never intend on purchasing bonds. In terms of your second portfolio with Robinhood, I really like the idea of getting monthly dividends. I think with SPHD and PAY, yes, you're paying a higher expense ratio, and you acknowledge that, you understand that. I personally think that you can get a monthly dividend in a different way, right? I've shared that on my channel in previous videos where you can invest in specific companies that have a payout on different months of the year. And so essentially you're getting paid monthly. And that's exactly what I do. SPHD is fine. PEY is also fine. Unfortunately, all the major ETFs that I invest in, they all pay in the same month. So it's difficult to get a monthly dividend from like an SCHD or a VYM, for example. I think if you absolutely wanted to simplify your portfolio, I think SPHD is fine. PEY is fine. I personally like doing it the other way, where I'm investing in individual companies that have a different payout schedule, as well as, my ETFs that pay on the, the standard, March, June, September, and December. I think it really comes down to your personal preference. I can see it going both ways. I personally invest into individual companies and ETFs that pay on a different schedule and don't invest into SPHD and PEY. But I think you could do either way. I think they both could work. It's just a personal preference. When it comes to your third portfolio here, this would be your sleep well at night, right? These are the companies, these are your dividend aristocrats. If you want to avoid dividend cuts, these are more your blue chip established companies that have a proven track record, that have maybe a competitive advantage, an economic moat, and are, sustainable. And so those are the thoughts that I have on what you're sharing here. I think you have a plan. I think your your $500,000 in debt is going to be a challenge, but it looks like you have a goal to aggressively pay it down. You could definitely, I'm assuming your earning potential, you could achieve financial independence in the next 10 years by the time you're 40, 41. Absolutely possible. So I think this is really exciting, and it's going to come with intentional spending, intentional investing, and it's not going to happen by chance. There's so many medical professions. I grew up in an area where there were a lot of doctors, like really wealthy doctors. On the surface, they appeared wealthy, but everything was on credit. Their brand new $1 million mansion was on credit. They had the loan, they were paying down a mortgage. Their brand new Mercedes was financed. The medical professionals, they're really smart, but they're typically not very good with money. It's just something to be aware of. And it sounds like you're one of the outliers, that you're different in a good way. All right, so this is just your dividend portfolio. It's not the other portfolios that you were talking about with your Robinhood and with the Vanguard Growth Fund. Let's take a look and see what you have in your portfolio here. You have it fairly equally weighted. So your top holding is Verizon. Warren Buffett just bought shares of Verizon. So that's, if you've been following Verizon, you probably saw a jump up here this last week. It was because Warren Buffett invested into Verizon. It's having the Warren Buffett effect. You got Realty Income, you got McDonald's, you got Lowe's, Illinois Tool Works, Johnson & Johnson, Caterpillar, DLR, CMI, ED, Comcast, okay, AbbVie, Cisco. So really established companies. You got your Pepsi, your Linde, you got Hormel Foods, Chevron, Air Products and Chemicals. Been talking a lot about them on the channel the last couple of weeks. Coca-Cola, AT&T, Verizon, Costco, and Bank First. Okay. These are all really, really great companies. A large percentage of the holdings that you have in your portfolio, I also hold in my portfolio. I like this. I think this is very straightforward. These are all companies with a great track record of dividend growth. I think the weighting is good. You're diversifying your holdings. You're not overweight in one single holding. I actually like this. This portfolio, this is leveraging M1 Finance at its best, right? I hope that you're setting up automatic transfers and you're just transferring over on a weekly or a monthly basis and just setting it and forgetting it. This is an ideal portfolio to just set it and forget it. Whenever you get extra cash, let's say, you make a little bit more money one month, or you do a side hustle, or you save money in one area or another and you got some extra money, just throw it into your M1 Pi and just, let it ride. I really like this. Or in your case, for example, against your debt, right? In this scenario, I personally would put all extra money towards paying down your debt. But I think doing like weekly or monthly transfers into your M1 portfolio like this, you set it up and it's going to continue to grow and compound. And once you're done paying off your debt, then all that money that was going to pay off your debt, you're then pumping it into your portfolios and it's going to be amazing. Ankit, thank you again for sending over your portfolio. All right, let's take a look at the last portfolio here from Dwayne. Dwayne writes, "Hello, Jake. I recently found your videos on YouTube and can honestly say you've inspired me to take my investing more seriously. Thank you." Hey, Dwayne, thank you so much, man. I really appreciate you saying this. This is so kind of you. And I mean, this is really the reason why I started the YouTube channel, was to help help other people learning about investing and inspire others to learn to invest. So you continue writing here that you're 35 years old. You would like to create $500 in monthly dividend income by the age of 50. All right, so you got 15 years. This is in a taxable account. You're currently contributing $200 a month with the goal of increasing your contribution to $400 a month in 6 months. Okay, so this is a very clear goal. Let's take a look actually in the dividend reinvestment calculator that I've shared here on the channel. You can access it for free. I don't charge anything. You can just access it. You can make a copy of it and you can plug in your numbers. But let's see what this would look like with your particular situation. So if we look at your scenario, let's assume, for example, that you have $0 invested today and you were to invest $4,800 a year or $400 monthly. And let's say your portfolio averaged in terms of capital appreciation, this is excluding the dividend. Let's say you had a 7% appreciation, you had a dividend growth of 7%. I just looked at your portfolio. It looks like you have just over a 3% current yield. So these are the numbers, give or take, plus or minus a percentage or so apart. But this is just kind of guesstimating what you could kind of expect if you were investing into your portfolio with these type of numbers. So the way that the calculator works is it's looking at what your current investment is, how much you're investing on an annual basis, and how quickly it's growing based off of the current yield, okay? And if you're new to this calculator, in the down here on the bottom, I share a few notes on how you can get these different metrics here up top. So you can take a look at that later after the video if you'd like. But essentially what we're looking at is we're looking at this column right here to see, okay, if you follow down this path for the next 15 years, and it's unlikely, right? It's unlikely that you only make $400 a month for the next 15 years. It's actually possible that you're making more in most cases, right? Due to inflation, etc. So if you were just to take these metrics and not consider any other assumptions, inflation, taxes, additional raises at your job, whatever, it would take you how long, because you wanted $500 a month, that's going to be $6,000 a year. How long is it going to take you to get $6,000 a year? It's going to take you just about 17 years. So with the metrics here, in about 17 years, you're going to reach your goal. And then you can see here what that would look like on the graph, that after 17 years, you're going to have over $6,000 in annual, dividends. And the cool thing is if you continue reinvesting the dividends, you're actually going to have much more. All right, now let's say, for example, let's use the scenario that you are investing up until the 17 years and you're reinvesting the dividend. And now let's say, okay, you've reached your goal. In 17 years, you want to then no longer reinvest the dividend, but you actually want to start living off of your portfolio. Or let's say you want to supplement some of your expenses with your portfolio. So your portfolio is still going to grow. Like the portfolio itself is organically growing, even if you're not reinvesting the dividend and if you're not adding to the portfolio. So what would that look like? Now, this is where it gets really exciting. Let's take a look here at the other tab where we're going to live off of the portfolio in the future. And so what we're looking at is column D here. And what we're doing is we're going to reinvest the dividend all the way up until the 17th year. So what we're doing is up for the first 17 years, we're reinvesting the dividend and we're investing in the portfolio. But after the 17th year, in the 18th year, we're then no longer going to add additional money to the portfolio and we're no longer going to reinvest the dividend. So the shares that we have are going to remain the same. So we're not going to be adding any additional shares, but the shares that we own are going to continually grow. So what will that look like? And this is what I love about dividend investing is it's continually growing, even if you're not funding the portfolio or reinvesting the dividend. So in your 18th year, even though you added no additional income to your portfolio, it is still growing. So in 20 years, you're now making almost $8,000. And in 30 years, you've doubled that, right? So it's not growing as quickly. Now let's go over this scenario here. This is the 30 year. If you reinvested the dividend and added the $4,800 every year for 30 years, you would have almost, $30,000. But we take the scenario after 17 years, this is what the portfolio is going to look like. So it's going to continually grow. It's not going to grow as quickly, obviously, because you're not reinvesting the dividend and you're only funding the portfolio for 17 years. But here's the picture, right? It's still growing. So this is the ideal state that we're looking for. So this is kind of a cool way to kind of project what kind of income that you're going to get from your portfolio if you continue funding it and reinvesting the dividend, and what that would look like once you reach your goal and you're just living off of the portfolio. So let's take a look at your portfolio. You're up 123% over the last 5 years. You have 50 holdings, just over a 3% dividend yield, no expense ratio. You have it fairly evenly weighted with tech at the highest, finance at the lowest. Let's see what you got in technology. You got your heavy hitters in Microsoft, Apple, and Qualcomm. You also got a big dividend yielder in IBM and Cisco, and you got Intel. Okay, all really, really great companies. Industrials, you got Waste Management, love it, UPS, Union Pacific, and 3M. All four of these companies I own in my portfolio. I absolutely love these companies. The weighting, I think it's fine. I think you don't have to over-engineer it, overcomplicate it. You can equally weight it. I think that's fine. Consumers, you got your Philip Morris, you got Pepsi, you got Procter & Gamble, Coca-Cola, Kimberly-Clark, and Clorox. These are all really good recession-proof companies. Like, I own the majority of these companies with the exception of Philip Morris and Clorox. I own Pepsi, Procter & Gamble, Coca-Cola, and Kimberly-Clark. Clorox is also a really, really great company. Great company. I've also considered adding Philip Morris. It's a strong dividend payer. Regardless of how you feel about, sin stocks and the social aspect of it, from a dividend perspective, it's a great dividend paying company. Let's take a look at your telecom. Telecom, you got Verizon, AT&T. Yeah, you got your standards there. You got your retail. You got Walmart, Target, Lowe's, Home Depot, and Costco. Every single one of these companies are going to be around in the next 10, 20, 30 years. These are great companies. Consumers, you got Starbucks, McDonald's, Genuine Parts, and Comcast, equally weighted. I think that's fine. You got your real estate. You got Realty Income, DLR, and Store. I mean, you're pretty overweight. You're heavy in retail REITs. You're 70% into retail. I think what I would encourage you to do when you're doing research more, on your portfolio, maybe look at other areas in real estate investment trusts. I like public storage units. I like cell towers. I like data centers. I like industrial buildings. There's a lot of other great REITs out there. Your growth, you got your Teslas, Netflix, Google, Facebook, and Amazon. Your big growth companies. I think that's fine. I personally like holding growth in a separate portfolio than my dividend portfolio, but that's just my personal opinion. Utilities, you got Dominion, Southern Company, PPL, Duke, and Edison, Consolidated Edison. I think these are fine. You may want to you could consider NextEra Energy, but I think as it stands, I think these are great utilities. Energy, Chevron, and ExxonMobil. If you do want to invest in energy, I think these are the best options. I personally don't invest in the energy companies. I get exposure to them through my ETFs, but if you wanted to invest into them individually, I think these are good, high quality companies. Healthcare down at 3%. You got Johnson & Johnson, AbbVie, Pfizer, and you got GSK. All right. Yeah, I think these are fine. Your finance, you got Visa, T. Rowe Price, JP Morgan, and Aflac. I like these. I like T. Rowe Price. They just increased their dividend a crazy, insane amount here just a couple of weeks ago. Aflac, they also increased their dividend in 2020. Really, these are great established companies. I don't think you can go wrong with any of them. I think with your time horizon, I think it makes sense. You have it equally weighted. I think that's fine. It's a good way to spread out your risk. Dwayne, when it comes to your goal, right, you want to generate $500 a month in cash flow on average, spread out throughout the entire year. They won't pay out $500 equally on a monthly basis. On an annual basis, you'll get right around $500 in cash flow from this type of a portfolio in the next 15 to 17 years, as we looked at on the dividend reinvestment calculator, with the assumptions that you provided. I think the portfolio is going to help you reach that goal. I think this is a high quality portfolio that you can set it up, forget it, reinvest your dividends, set your portfolio on autopilot, have automatic transfers on a weekly or monthly basis, and sleep well at night. Thank you so much for sending over your portfolio. I think it is so interesting to see how different people are investing, how different people are set up for success in different ways, right? We saw that an 18-year-old from New Zealand is already learning about finance and investing in their portfolio. We saw that somebody in their 30s is starting their career with almost $500,000 in debt, but they have a goal of reaching financial independence. Everyone is in a different scenario. Everyone has a different situation, a different challenge, a different advantage that, that's what we call life. I love dividend investing because it creates financial independence, financial freedom. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. If you like today's video, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.